Hey everyone, welcome. This week we're very excited because Bill and I get to share our friend Jim Chaston, who is, well, he's been my accountant for, gosh, quite a long time now. And Bill and I started talking a few weeks ago about reverse 1031 exchanges. Now, 1031 exchanges may be more common for you to know about. It's when someone sells a property and then they're in deferring their taxes from that property to another property or land or some other stuff. And Jim can tell us more. It's not necessarily like for like. You have other options in there, but we started also talking about the lesser known version of a 1031, which is the reverse 1031. So Bill and I were like, hey, we should bring Jim on to talk about this because they're, I don't want to say overly complicated, but there's a lot of really important pieces that you cannot miss. And I think that's where people go awry. If they're not set up with the right people or understand the system, then they get in trouble. So everyone, please meet our good friend, Jim Chaston. Hey, Jim.
Hey, good morning.
Good morning. And of course, thanks for being here again, Bill. Always appreciate you.
Always here.
Thanks. All right. So Jim, share with us what exactly is a reverse 1031 exchange?
Yeah, so a reverse 1031 exchange is basically instead of selling your property and then buying the replacement property, you buy the replacement property first and then sell sell your property. And so you do it in reverse. The complicated part is you still can't take title of that property that you bought until after you sold it. So you have to have what's called an exchange accommodation titleholder, an
Okay.
EAT. Generally, you get one that's affiliated with your qualified intermediary, which you use in a normal 1031 exchange that is normally affiliated with the title company. So you have all three of those entities that you need in a reverse 1031 exchange. And it's just a little bit more complicated because the lender has to get involved in, you generally are going to have to guarantee the note because you're still buying it, but it's going in somebody else's name until you can sell your property. And you normally do this because you've got to close on that replacement property before you can sell the property that you have. And
Yeah, because the reason we did the reverse 1031 was because it was really easy to sell a property at that time, but really hard to identify a property. And with 1031 exchanges, you've got specific timelines, right?
Yeah.
You have to identify properties within 45 days. Now, can you share a little bit more about what that identify properties? I think that's where I sometimes get confused too. Like, are you allowed to say, I identify any property that will ever be listed from today until 46 days from now or something like that? Or do you have to have addresses? Like, how does that identifying process work?
You actually have to identify the address. You have to identify the exact property.
So you can't do general. So you have to
You
sort of,
cannot.
yeah. So this is kind of the challenge we had and why we did the reverse was because we didn't know, like we could identify properties, but what if they sold without us or we couldn't get we couldn't land that one because we had already tried to buy some stuff up in Sholo and we had been outbid quite a few times.
Yeah.
So that was kind of where we were really concerned about this 1031. Then you had mentioned doing this reverse and we're like, oh, that opened our eyes. But like you said, you have to be very particular about who you pick as that intermediary because they're going to technically own your property. And if they don't have a really good history of actually giving properties to you want to actually buy it.
Yeah, exactly. And generally, so you're going to buy it, it goes in their name. You're still a guarantor on the loan. You got to have a lender that agrees to do that. You got to have the company that agrees to do that. There's generally going to be, you're going to have a lease or use agreement with that until you get your property sold. There's going to be a call or a put option on that. Might need to get done. So agreements that also have to be in place. You got to have the money and the lender that's going to agree to do that. And not all
Yeah,
lenders will do it.
yeah, that's the catch is because technically you don't have the property in your name. So,
Right.
and there's a very shy to do a reverse 1031 when it's in some other 1031 company's name. So that's where that hard money loan or private lending comes into play. Then once it's in your name, you could refinance it, snap it out of that, put it in a 30-year fix or whatever you want at that point. But yeah, that's the thing that lenders will always hesitate on the conventional world is not touching that because you don't have the property in your name.
But once it's what is in your name. So what we did was we used a hard money lender. We had the down payment from the exchange. Then we did the hard money loan. And then as soon as we flipped out of that, we were able to refinance it to a regular deal. So, I mean, all that didn't take very long. It was like, it's not like we held
So
on
you
to
could
hard
you
money.
can tee up a lot of the lending throughout the process, right? So
Yeah.
like once you identify the property, you start with the hard money lending. We just can't flip it to an application until you actually have it in your name, till it's complete. But we
Right.
can get like maybe a pre-underwrite done. We can get things done to make sure that it's a quick turnaround. I mean, I have plenty of investors that will buy homes, not 1031, but just homes with the hard money. And I've
Mhm.
already fully underwritten their file. So that way, when they close on the home, that file is closed within 15 days. So they only have 15 days of interest, right, that they pay. Similar to reverse 1031, you want to get out of the hard money loan so you're not paying the interest, but
Mhm.
we're quick on that because we can clean up things ahead of time.
So, Jim, how does now when you're in a regular 1031, you have the 45 days of identifying, you have to close on that property in 180. What are the timelines on the property you have to sell? Because now you have this house you already own. What with this other property that you're trying to sell, what are the timelines on that? How does that work?
It's actually identical.
Okay.
And the 45-day rule is kind of, you already have bought the new property and you're
Right.
identifying the property that you're selling. Now, one thing that could happen is, say you have 4 or 5 properties and you're trying to figure out which property you're going to sell. So there's still a 45-day rule. You have to identify the property that you're relinquishing essentially,
Okay.
because you've already bought the new property. And it's a 180-day rule as well, as
Okay.
far as from the date that it goes into the exchange accommodation title holder, the EAT. You got
Mhm.
180 days to get it titled into your name.
Okay.
Well, so you've got to sell your property and get that property back into your name 180 days after you acquire the first property.
Okay. So there are still time constraints and things you have to really pay attention to.
Yeah.
Okay.
One thing I
Let's
want to bring up is
Yeah.
when people are looking at a 1031 exchange, first thing I always recommend is, what's the tax on the sale if you did
Mhm.
do a 1031? Figure out what that tax is going to be. In today's world, because real estate is appreciated so much, I mean, it's almost a no-brainer to do a 1031. But a few years ago, I had people wanting to do 1031 and they're deferring $8,000 of gain.
Mhm.
The cost of the 1031 is 2,000. A reverse exchange is going to be 2 or 3 times that.
Yeah.
You-
We had to pay 1% of the loan amount.
Yeah, there you go.
Yeah.
Plus all of the other exchange costs on top of that. And so, you got to find out how much tax savings are you actually going to do. If it's a couple $1,000s, it may not be worth it. Just recognize it. And it's a long-term capital gain, and just recognize that at 15% anyways.
Yeah, so we just sold one of our rental properties and we really didn't make much on it. It was we did well on the rental part of it, but appreciation wise, it didn't do that much. And
Right.
so we're like, all right, well, it didn't make sense for us to, like you said, spend that money for really no reason.
Yeah. And then you're going to pay an extra, $1,000 on the cost of the tax return too, with a 1031. And
Mm.
because you're deferring the gain into the new property. So you have to reestablish the depreciation basis on everything. And there's a fair amount of work to do on that.
Gotcha. Okay.
Can we talk just a minute about what qualifies for a 1031?
That would be fantastic because that is very confusing to people because people think, oh, well, if I sell a house, I have to buy a house. If I sell land, I have to buy land.
Yeah. So this changed just a couple of years ago about what qualifies for 1031. It's real property used in a trader business for investment. So a primary residence does not qualify. A second home does not qualify. A fix or flip does not qualify. So a rental property does, or a piece of raw land that you're using for speculative investment qualifies. Farmland qualifies. Commercial building qualifies. And you can, when you replace, you can buy any one of those. So you can exchange commercial building for a piece of raw land, as long as it's going to be used in a trader business and not to build a personal home. And ultimately, what the rules say, what is the ultimate use, the final use of that property that you intend for it. And so technically, if you sell a rental property and you buy a property in California that you want to convert to your second home, that does not qualify.
Okay.
So if that is the intended use, ultimately down the road, it doesn't qualify. Now, if in 2 or 5 years it changes, becomes that was achieved after the fact and not the initial use. And so that still qualifies.
And I know I get this question a lot. Well, after I do the 1031 exchange, how long do I have to rent it out? Either before I sell it again or before I decide this is going to be, I want to live here, or I want to give it to one of my kids, or I want to do something else with it. And I don't know if there's any hard and fast rule for that, but what are your thoughts on that? Like, how does that typically work?
There's not, but it does go towards the intended use when you buy it.
Okay.
If 3 months after you buy it, you transfer it into your kid's name or you convert it to a second residence, yeah, IRS is going to have a hard time. That was not the intended use. And so normally what I'm going to say is you want 2 tax years of rent as a safe harbor. I mean, it's not really a safe harbor, but you sell it in June and you've got it rented in that year. You've got it rented the next year and then it converts. Is that enough time to say that was the actual intended use potentially? I like to see 2 years at least, but yeah, it ultimately comes down to, what was the intended use when you bought it?
And Jim, when you look at the tax returns and when you fill out the tax returns on that investment property and days of rent, with the day and age of short-term rental, is there a minimum days of rent on that tax return you have to show that intent of an investment property?
No. So really it comes down to, and it's not just the number of days of rent, it's the number of days actively seeking rent for it.
Okay.
So if you've got it advertised, that goes into that calculation as well.
So like it's been on Airbnb the whole entire time, but because maybe it's a vacation rental and the market's just slower on vacation rentals, so you haven't rented it in 5 months, you've had it advertised and you can show your pricing's been fair to market and nothing, then that at least gets taken into consideration.
Absolutely. But don't do this. Don't say, hey, I'm selling this property and I'm going to convert it into a house on the beach that is going to be my retirement home. And you put that out on Facebook or Instagram. Don't do that.
Oh, really? Like you can't say like 10 years from now, I want to make this my home. They want to.
Yeah, that doesn't qualify as a 1031 exchange.
Ooh. No one ever heard me say that.
So, yeah, I mean, because that's the ultimate use. Is to be a retirement home, and then it doesn't qualify as a 1031.
That makes sense. Even though you're renting it, it's what your intention is.
Yeah, you intend to convert it to your primary residence or retirement home. Then
quite honestly, doesn't everybody just sort of think that anyway in the back of their head, like, oh, this would be a fun place to live later on in my life?
I get it, and the law says the ultimate.
Oh, that crazy law!
I know exactly. That's 1031 code.
Like when you're arguing about guidelines, Christy. Love it.
I know. Well, I swear, if sometimes if people would just listen to what I suggest, it would be a lot easier to live life. But hey, whatever. I see in my world, I want people to dream big. So I'm like, hey, if you bought this house, it'd be great because one day you can. We'll just make sure we don't say that out loud to anybody else.
Yeah, don't put it on social media.
Don't put it on the gram.
Don't put it on the gram. Yeah.
The IRS is now using AI.
Get out.
They are now using AI.
Oh, that would have took them longer to figure that one out.
And if in an audit, they're going to search social media.
Oh, no way.
Oh, yeah.
Oh, this is good to know.
Because it's public because you're putting it out there.
Yes. Whew. All right. We're all going to start having to, it's interesting because now we're talking about having to prove who we are as humans versus
oh my goodness,
bots and AI. So
yeah,
I'm going to be like, that wasn't me. Wasn't me. Somebody else. I know someone hacked my system.
But yeah, 1031s are amazing to do that. And I love it in real estate because if you've got a property, you don't want that property anymore. And so you can do a 1031, defer the gain into the new property. And then I love it as an estate plan as well, because then you hold that replacement property until you die and the kids get it stepped up to fair market value and you never pay tax on it ever.
That's nice. All right, let me ask you this and your opinion or what you know on it. I know there's been a lot of talk about changing that capital gains from 500,000 to $1 million for a married couple and the 250 to 500 for a single person based on the amount of appreciation that we've seen across the country over the past, what was it, 1991, that law was put in
And
place.
you're talking about the primary residence.
The primary residence capital gains issue. Yeah. So do you see any potential future where they're going to change those numbers? Like, have you heard of anything or like, what do you think the odds of
Not, but I expect it to happen. And unfortunately, they didn't tie it to inflation. And so it's just a set number. So Congress has to come in and actually set that number. And they generally have to do it because of the Budget Reconciliation Act requirements to balance the budget. And so, but I do expect them to come back. Originally, it was 125,000, a little bit different rule. That changed in 1996.
Right.
Well, the 250 and 500 has been around since 1996, 29 years, and is not adjusted for inflation.
Well, this is kind of where when we were talking about the 1031s and not doing the primary residence, I know people who have made so much money on their house now, it's over that $500,000 limit. And the tax implication for them, even though they're like, I'm trying to explain, but you've made that much more, they do not want to pay that extra, in some situations, like $80,000.
Right.
So,
Oh, that's exactly right. Or they use part of their house for a business. They've got a business on their house. This is an area where they can use both the 121, which is the primary residence exclusion, and the 1031, because they use part of their house for a business. They have a mother-in-law suite or casita that they use for the business. And so they can use both. But do I see it in the future? I expect it. I have not heard anything about it at this point in time.
interesting. Okay. Well, excellent information as always, Jim. And like I said, Jim is, he's been doing our books for years and
Decade now.
oh, it has been crazy. I know. And I'm like probably his worst pain in the tail client when it comes to getting him stuff. I'm so not that person that gets stuff. I'm not a numbers person. So for me to do it is like really painful, but he's so nice about it every time. He's like, Christy, it's due. Christy, we need to get this like next week. So always appreciate your patience and your kindness, and your explanations are always ones I can understand too, which I love because, some people talk above your head, and even after I've heard the explanation, I'm still not sure of things, but you do such a great job of helping me understand exactly what I should be doing, what I should be looking into, options, and like, hey, you can do this. You don't have to, but if you do, you may want to think about this. I think about the first time you put me into like a K1, I was like, look at that. Like all those things I learned about my business, and you're just I know it's brilliant. It's fantastic. Probably later than I should have in life, but grateful that I did finally.
Well,
So,
it's all about saving your tax money, keeping your own pockets so you can do more investments.
yes. Well, thank you for that. Bill, thank you again for being here and always being a fun part of our weekly call. Well, you all enjoy the rest of your week and we'll talk to you soon.
All right. Thanks.